I think China may have already flipped this switch on some level, at least for certain goods, right? I think they were already saying, we'll send you all the rare earths you want for gold. None of this toilet paper dollar crap. None of these treasuries that you print at will. Forget that. Send us gold. And I think we've been forced to, because what lines up with 5 months ago? That's when Bessent and Trump met with the Chinese in South Korea. Oh, by the way, the 5th month, it was only the second biggest export. I think the dollar reserve, is the dollar going to still be the reserve currency? Gold's already supplanting it as a reserve asset. And I think that's going to continue. And everything we're doing is going to keep pushing us in that direction.
So 1 year. That's interesting. We're up 39% in 1 year. Let's call it 40%. So don't forget, 1971 to 1980, it was averaging 46% per year compound. We're up in 39% over the last 12 months. This could be another bull market like we saw in the 1970s when inflation started to rise.
Global markets are entering a phase where trust, settlement power, and reserve assets matter more than headlines. The old system was built on confidence in paper promises, but that confidence is now being tested by sanctions, debt growth, and rising geopolitical rivalry. When nations begin questioning settlement risk, they naturally search for alternatives outside the traditional dollar framework. Gold sits at the center of that conversation. Luke Gromen, a macro strategist focused on sovereign capital flows, and Clive Thompson, a market analyst watching structural shifts, explain that gold may already be replacing part of the dollar's reserve role behind the scenes. They point to stronger central bank buying, expanding non-dollar payment systems, and growing interest in settling strategic commodities with hard assets rather than paper claims. If that trend continues, gold could see another major revaluation cycle, similar to the inflationary decades of the past. Their broader message is clear: the reserve system may not collapse overnight, but it may be gradually changing now. Now, we present the clips from their interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
I think you're exactly right that the sanctions, etc., have undermined the dollar system in a major way, and in a way that its biggest proponents downplay, wrongfully so, in my opinion. When you go back to 2012, when we kicked Iran out of the SWIFT system, to me that was like using an elephant gun to kill a fly, because had we not done that at the time, we would have still had that surprise in our bag. And when you look at how China reacted to that, here too, there's just not the appreciation. You would rarely hear that the Chinese were scared to death. The Russians were scared to death. Like, oh my God, they could hyperinflate our economy overnight by doing this. By 2015, China had the CIPS, China International Payment System, up and running. Second set of rails alongside SWIFT. Volumes on that have risen massively. I think it's doing, 45 trillion yuan. So, $7 trillion a year now through there. They've had other, and as a friend of mine said, it's not just like so much what the Chinese do. They don't invent it, but when they make their own version of it, it's better than yours. And that's what they do with CIPS. So it's not just a messaging system. It is also, it's messaging, it's settlement, it's everything. And so they've set up this entire, and then they set up offshore yuan clearing banks in every major gold hub in the world. You look around, there's an offshore clearing bank in London, Switzerland, Dubai, Singapore, Hong Kong. And so the rails are already all there. They've already have, the e-yuan's been being tested. Guess where they tested it first? In oil markets and gold markets. The Project Enbridge with the BIS has been discussed. Some of the oil guys, to me, I think there's maybe something there. I don't know. But I think your point is very, very valid, that is wildly underappreciated in dollar circles, which is they can absolutely just hit a switch. There's no more kicking them out. They've got all the factories. They're short energy and food on some level, but they're partnered with Russia. And we've angered the Russians as well. I mean, to me, the history books will not be kind about the weaponization of the dollar unless the goal was getting rid of the dollar system and pushing Russia and China together. I mean, how foolish from a strategic standpoint. And so, yeah, I think ultimately when I look at dollar reserve status, there's a lot of debate around what that means. And to me, any debate, anytime people want to talk to me about that, I first want to define that. What are we discussing here? Mm-hmm. Are we discussing FX reserves? Because if we're the actual reserving of dollars, which is, in my opinion, what matters, right? The U.S. dollar as a reserve currency it is the currency that is most reserved. Well, gold just supplanted treasuries as the biggest reserve asset of global central banks. If you would, there was an article in Bloomberg last week or 2 weeks ago. If you make adjustments based on it's an adjusted figure, so it's not a gross figure. As it stands now, the dollar is still bigger slightly than gold in global FX reserves. At $6,000 gold's bigger than the dollar. So it's not that far, much higher than here.
Right.
But on an adjusted basis, gold has already supplanted the dollar in FX reserves. And so will dollar reserve status, what will happen to it? Well, it's already being supplanted by gold. Like, nobody wants to hold yuan. People say, oh, who's going to hold the yuan? Of course they're not going to hold the yuan. Number one, back up. Anytime someone says to you, well, would you hold the yuan? Back up and ask them, first, in order to reserve a currency, you have to run a surplus against that currency for them to pay you in that currency. Who runs a surplus against yuan? Nobody, except for the Gulf Arabs and Russia sometimes. Every now and then the South Koreans do in semiconductors. Okay, so that's the only way you could even get yuan, starters. But then they've set up this system of it's our currency and it's our problem, which is if you do end up, you're a Gulf Arab, if you're a Russian, you end up with yuan payment for your oil and commodities. What can you do with that? Well, turns out they're the factory of the world. So there's a whole lot of really good stuff you could buy from them in yuan. And then if you have any yuan left over, take it to Switzerland, take it to London, take it to Dubai, take it to Hong Kong, and exchange it for gold at any of these offshore clearing banks. And you want to take the gold home with you? Great, take it home with you. You want to leave it in Shanghai? Great. You want to leave it in Hong Kong? Great. You want to leave it in Switzerland? Great. And so what we're watching in real time is the supplanting of treasuries as premier collateral by gold for this parallel system. And, I think the dollar will always be the primary used currency. Number one, because we're running the biggest deficits. Number two, it's a reserve. But the dollar, when you talk about usage, it's 90% dominant. Great. You know what? In Chuck E. Cheese, the tokens are 100% Chuck E. Cheese tokens in Chuck E. Cheese. And the world, the dollar is based on where we are. The world is Chuck E. Cheese, and the dollar is the Chuck E. Cheese tokens. But tell your kid, hey, just store all your money in those tokens. No, they want to win tickets and they want to go to the prize counter, right? Mm-hmm. And China's the prize counter. That's where the real value is. And I think what's going to happen is that, we're going to push this thing too far in Iran or elsewhere, and China's just going to go, look, switch is on, boom. We're you want to cut off our oil? Great. We're now demanding yuan for rare earths. We're now demanding yuan for the components from XYZ. Well, how's anybody going to get yuan? We saw this question around Iran in Hormuz around, people, when they demanded yuan for payment. People, that's stupid. There's China doesn't run the surplus or the deficits to supply the yuan. Exactly. That's what the Chinese are doing. How do you get yuan? It's very, very simple. You sell dollars, you buy gold, you take the gold to the Chinese, you sell the gold to the Chinese for yuan, you take your yuan, you go to the Iranians and say, here's yuan, my oil. Mm-hmm. So when, if we push this too far with China and they go, we're done here, pay us in yuan. Like we did to the Brits, by the way, in World War II, right? When the Brits needed money for us or needed weapons from us in 1940, reserve currency, 150-year history, great relationship. What did we say to the Brits? Nope, none of that sterling toilet paper. Reserve currency toilet paper. We want dollars and we want gold. Or you don't get your ships. You don't get your bullets. Same thing's going to happen. It's just a matter of time. What's the trigger? And so the Chinese are going to go, yuan or it doesn't sail. Okay, well, what do we have to do? We got to go buy a bunch of gold with dollars, print dollars, buy gold with printed dollars. Buggy. Take the dollars to China, or take the gold to China, excuse me, sell gold to China, obtain the yuan. Here's your money. And so it's very interesting to me in the light of all of this. People say, oh, Luke, that is so far-fetched. Guess what the number one export of the United States has been for 4 of the past 5 months as the U.S. trade deficit has narrowed to the celebration of all the, of the Trump administration? Non-monetary gold. 4 of the last 5 months, the United States, the mighty United States' single biggest export has been non-monetary gold. Bigger than airplanes, bigger than pharmaceutical preparations, bigger than the automotive industry, bigger. Where's it all going? China, Hong Kong, Switzerland, some to the Gulf countries. Where's it going from Switzerland? The Swiss are very precise with their records. Guess who Switzerland's biggest export market has been over these past 5 months? China, Hong Kong, some of the oil countries. I think China may have already flipped this switch on some level, at least for certain goods, right? I think they're already saying, we'll send you all the rare earths you want for gold. None of this toilet paper dollar crap. None of these treasuries that you print at will. Forget that. Send us gold. And I think we've been forced to, because what lines up with 5 months ago? That's when Besant and Trump met with the Chinese in South Korea. Oh, by the way, the 5th month, it was only the second biggest export. So anyway, that's a long-winded answer. So I think the dollar reserve, is the dollar going to still be the reserve currency? Gold's already supplanting it as a reserve asset. And I think that's going to continue. And everything we're doing is going to keep pushing us in that direction.
A major theme in this discussion is that reserve currency status is often misunderstood. It is not only about headlines or official labels, it is about what countries actually choose to hold when they need safety, liquidity, and political neutrality. That is where gold becomes increasingly important. The speakers argue that years of financial sanctions and currency weaponization may have accelerated the search for parallel systems. New settlement rails, bilateral trade agreements, and commodity transactions outside the old model suggest diversification is already underway. If nations no longer want to rely entirely on dollar reserves, they may shift toward bullion, strategic resources, and regional currencies. That does not mean the dollar disappears tomorrow. It means demand could slowly weaken at the margin, while gold demand rises steadily. If confidence keeps eroding, gold may move much faster than many expect. The transition could be gradual, but markets often price these changes suddenly. Let's get back to the interview.
So here we're looking at the long-term chart of gold, and it looks like it's going parabolic now, but actually that's something which does happen from time to time. And I'm just going to turn this into a logarithmic scale, which is more telling, and we're going to focus on the period from 1971, that would be August 1971, when Nixon announced that gold was coming off the gold standard and that there would be no more gold. So gold at the time was around $35, and it went all the way up at its peak to $850 just here. Now, that's 1971 through to January 1980. So if gold was $35 in August 1971, $850 in January 1980, what was the annual rate of increase? Let's just ask ChatGPT that. If gold was $35, hello there, hello ChatGPT. If gold was $35 in August 1971 and $850 in January 1980, what was the annual percentage rate of interest or increase? We're talking about the compound rate of increase.
The annual compound rate of increase was about 46% per year.
So there we have it, 46% per year was the increase. Now let's take a look at what's been going on in the last year. So I'll click on the 1 year chart here. Just get rid of that little line there. Oh, I can't get rid of it. And then we're going to see what percentage it would be. So let's just put that as a percentage over 1 year. So 1 year. Ah, that's interesting. We're up 39% in 1 year, 13, or let's call it 40%. So don't forget, 1971 to 1980, it was averaging 46% per year compound. We're up in 39% over the last 12 months. This could be another bull market like we saw in the 1970s when inflation started to rise. So let's just talk about adding a small proportion of gold to your portfolios and what it might do for you. So even a small allocation to gold, it doesn't just improve diversification, it changes how your portfolio behaves. It reduces the volatility. So the volatility of your portfolio tends to smooth out, drawdowns become less severe, and overall your risk-adjusted returns improve. Gold isn't there in a portfolio to beat equities. It's there to balance out the swings. When markets get unpredictable, gold quietly starts to do its job. And I think we're getting into a situation right now where the stock markets are starting to look a little bit dodgy. And we're going to look at the, let's look at the NASDAQ index. Now, it's pretty high, but you can draw your conclusion. Is it starting to look a bit dodgy or not? It's heading to an all-time high. I don't take a strong view on it other than to say it's a bit overvalued. But if you feel that stocks are getting shaky, you want to have a little bit of gold in your portfolio. Now we get to silver, which I think is the most compelling asset to hold in your portfolio right now. It doesn't mean to say you should have a large position. It just means that I think that some silver in a portfolio is going to be a good idea for the coming years. And this is not investment advice. This is just my personal opinion. And you shouldn't take advice from a guy who's retired and not working in the financial industry. So let's start by looking at the Silver Institute's supply and demand. And I'll focus first of all on this top line here, which is called mine production. And we can see that mine production has been falling. Over the last decade, we have seen mine production fall from 900 million ounces down to 835 million ounces. So there's been a fall from 900 to 835 in mine production in millions of ounces. And the total supply, including all sources, has dropped from 1,057,000 to 1,030,000. So what we can see, first of all, is that silver production or silver availability coming out of the mines or other sources is not going up. Rather, it depends whether you look at mines, it's falling steadily, or if it's looking at other sources, it's still falling. So production is falling, or availability of new silver is falling. And then we look at the demand side down here, and we see that the demand has risen from 993 million to 1,148,000,000, or 1.1 billion, if you like. So demand has been rising. And a couple of years ago, we saw the crossover point where this was 2021, where the demand here at the bottom, 1102, exceeded the supply of 1023. And we've been in deficit ever since then. So the bedrock of the silver argument is the persistent deficit since 2021. And 2026 will mark the 6th consecutive year where demand exceeds what miners can produce. In 2025 alone, demand outpaced supply by 170 million ounces, with mine production stagnating at just over, according to this, just over this this number here. If we look at it, they say 835 million ounces. There could be some discussions about whether that figure is correct, because it is just a forecast. Obviously, the final numbers are not in yet. So when a market, including silver, runs a deficit year after year, it's eating into the above-ground stockpiles. And there are a lot of above-ground stockpiles, but they're still finite. And as stockpiles shrink, holders become increasingly reluctant to sell unless prices rise. That's a classic scarcity dynamic that's been a major driver behind silver, and especially behind silver's recent strength. and there's very little evidence that the deficit will be resolved in 2026 or beyond. The next point on silver is the price performance. Silver has risen. If we look at a one-year chart, I'll just bring that up as a percentage instead. So we'll do that percentage, and we're on 1 year. There we are. Over 1 year, silver is up 142%. Towards the end of January, silver very briefly breached the $100 level, going up to something like $126 very, very briefly. But even at these high levels, the structural argument remains intact because the deficit hasn't closed and doesn't look like it's going to close. The demand for silver continues to rise constantly and steadily due to increased usage in the electronics industry and, of course, the solar panel industry.
The deeper warning from Luke Gromen and Clive Thompson is that monetary systems usually change quietly before they change visibly. For years, markets focused on interest rates, stock indexes, and short-term economic data. But beneath that surface, sovereign behavior may be shifting. Central banks have been accumulating gold, trade blocs are discussing local currency settlement, and strategic rivals are building alternatives to existing payment channels. Those are not random events, they are signs of preparation. If this trend expands, gold may benefit in two ways. First, it is a reserve asset with no counterparty risk. Second, as a pricing benchmark, if confidence in fiat liabilities weakens further. That could mean higher currency volatility, stronger commodity prices, and renewed investor demand for hard assets. Silver may also follow if gold leads the move. The speakers are not predicting an overnight collapse. They are describing a slow-motion repricing of trust. History shows that once markets recognize a structural shift, the move can become rapid and self-reinforcing. Investors who only watch daily noise may miss the larger transition already underway. Share your thoughts on their analysis in the comment section below. If you find this video informative, please support and turn on notifications to stay informed about our latest videos. See you in the following video. Thanks for watching.